look at the various workings that we have to do now under the high purchase. So, in doing the high purchase, we need to find out at the end of the day how much money did we actually receive, and then how much money is outstanding from the high purchase. So let's start the journey with the March sales. For the March, the high purchase price was how much? 1750. Okay, so the people who make a deposit of 35% of that. Is it 35%? So 35% of 1750, what do we have?
617.
I'm coming. Right? 613. So amount outstanding. 1137. Then we are told that the amount outstanding will be paid when? In 7 equal installments. So installments per month. What do we have? So this figure divided by 7. 16 to the nearest million. 162. Now, from March, we are told that all other installments were received. All other installments were paid on due what? Date. So, from March to December, they say how many months? 10 months, isn't it? No. So, meaning that installment. So, let's look at the installment payments. So, March, April, Obetia 162, isn't it? May, Obetia 162. June, Obetia 162. July, Obetia 162. August, Obetia 162. 1, 2, 3, 4, 5. August, from August you go where? September 162. October 162. Says 1, 2, 3, 4, 5, 6, 7. So meaning the March sales, no amount is what? Outstanding. Everything has been what? Paid. Does it make sense? Okay. I don't need this. I just did that for your workings. Next one, April sales. Let's see what's happening in April. Remember, it was the September sales now. Sorry. September sales na December. Into a honor you do a better adjustment. So April, what was the sales?
So it was July.
Okay. So July. No April. There is April there.
No, I mean, where the adjustment should be.
It's what?
I thought it's in July.
I see the computer sold in July. Okay, true. So we will do the adjustment in July. April sales, let's go. April sales.
2356.
2356. Deposits, 35% of that. 825. Amount outstanding. 1531. Installment payment or installment per month.
Is that 127?
Yes, say ni 7. And 219. Okay, yes, all installments were paid on due date. Indeed, where was April? So they will pay in May, they will pay in June, they will pay in July, they will pay in August, they will pay in September, they will pay in October, they will pay in what? November. So 1, 2, 3, 4, 5, 6, 7. So meaning this one also, everything was what? Paid. Are we following the picture? Okay. Then let's come to the next one. July. Hana Semon. July sales was how much? 6,000. Deposits, 35% of that. 2,100. Amount outstanding, 3,900. Monthly installments, divided by 7. 556 7. Did you say 7?
Yeah. 557.
Approximately. So every month they are supposed to pay 557. Now TNE, the examiner said in October, because they defaulted what? September. Meaning from July they paid August. And no pay no mutual. Because they didn't pay in September. That is why in October the goods were repossessed. I don't know if you get a statement there. It says computers sold in July were repossessed in October after non-payment of what? September. So meaning that the only installment they paid was what? 557, which is what? The August one. So they didn't pay in September. They didn't pay October. So that one, this is the only thing we will take into consideration. We will come back to the repossession account on this one. But let's go to the next one. September. What is September sales? 2121. Deposits. 35% of that. 742. Amount outstanding. 1379. Installments. Monthly installments. 197. Okay. So if in September, that means they will pay when? October, they will pay November, and they will pay what? December. But as at the end of the year, that means how much is outstanding? Debtors outstanding from the September sales. They are left with 4 installments to go, isn't it? So with the 4 installments to go, that will be, so outstanding at December will be 197 times 4. That will be what? 788. So that is debtors for the September sales. I hope you are following the picture. Very simple, right?
Yes.
I'm saying that we made the sales in September, and the installments are paid the month following what? You start paying the month following the sales. So if September, that means in October they pay their installments. In November they pay their installments. In December they pay their installments. We are in December. So how much is left now? We are left with 4 installments to go. Why are we interested in this? Because we are preparing income statement and balance sheet. So how much installment is outstanding as at December? So they paid October, they paid November, they paid December. So that money is with us already. But now what is the debtors figure outstanding? 4 installments to go for the September sales. Because you pay 7 installments. Everybody is going 7. So if you have received October, November, and December, we are left with 4. So that 4 becomes what? Debtors in the balance sheet for the September sales. Make sense now? Okay. So please write, and then let's do the rest. We are left with 2 more to go. October and then November. Okay, so where are we? We just did September. So let's go to Oct. Oct sales is how much? 5795. Deficit. 35% of that. 2028. We go. Outstanding. 3767. Installments. Monthly installments. 538. Once I did it, 538. And you're being grabbed. Now, if we did a sales in October, then when will installment payment start? November and what? December. So how much is outstanding? 5 months to go. So that goes to debtors. So outstanding for December will be 538 times 5. What do we have? 2,690. Okay. So debtors figure for September is this. For October is that. Then let's go. Last one. North. What's the sales for North? 4,800. Deposit. What we got? 1,680. Amount outstanding? 3,120. Monthly installments? 446. Okay, now, if they did a sales in November, then deposit will start from where? Sorry, installment will start in December. Now we are at December, so how many months are left? 6. So amount outstanding as at December. Alright. Okay. Will be what? 6 times 446. What do I have? 2676. There you go. There you go. So these are the various workings we do for each month, and it follows in this order. That's how high purchase is done. It follows in this order for us to get a sales for each month. So the goods that have been repossessed, we are going to prepare what we call repossessed account. So goods repossessed account, and we're working in million. How do we prepare this account? On the debit side, we will bring the cost price of the goods we repossess. So what is the cost price for the months? Which month did we do the thing? July, right? So cost price for the July sales. How much is it? 4,000. Then on the credit side, we will reduce it with the deposit that the guy paid. How much deposit did he pay? Did they pay for the July? 2,100. Then what was the proceeds? How much did we sell the repossessed laptop? 140 million. So I should write 140 here. So I should write 140 here. Eh? Yeah. Okay. So what do we have? We balance. The balancing figure will be profit or loss on the disposal. Which side is bigger? So 1, 2, 3, 4, 5, 6. Okay, so 140 million. The debit side is bigger. So 4,000, 4,000. So the balancing figure here will be a loss. That means we made a loss on the repossessed goods. Of how much? 1760. If it was here, we would call it what? The profit. So that's the repossessed account.
So with the repossessed account, we use the cost price.
Yes, on the debit side, because you can't use the high purchase price because you have repossessed the goods.
How do you go into the counter?
The installment he paid. No. Say under hire purchase, whatever installment that he paid, it's gone. Are you getting the idea? So we won't consider that one. How much installment did he pay? 557. No, I'm coming. Because this is the deposit he made, right? Yes. Then he paid this installment. Then we sold the asset for this. No, we won't consider that one. In the goods repossessed account. We won't consider his installment. Because we are just looking at the goods, not the money we are receiving from the goods. So if you are looking at the goods, that's why we use the cost price. So his deposit will be deducted from the cost price. Then how much did we sell it for? They will get a profit or loss on the repossessed goods. So in actual sense, it cost us this much. He gave us this deposit. One. The ACCA, the value of the goods we took from him. Do you get it? Then we deduct the proceeds from it. So that's why we won't consider what? The installments that he has paid on the goods. Now, let's do some workings quickly. How much is outstanding now? Total debtors. Who figures need that? So give me hire purchase debtors. Which month did we start having the debtors? So September, how much did we calculate for? 788. Confirm. And then October 2690. And then November 2676. So we add all. That will be the total hire purchase debtors. Six one. Okay. Now I want you to do this for me. Add all the cost of sales. Cost price, and write the answer down. Let's get the answer. And then the higher purchase price. Add all as well. So do the additions there. I don't need to do it here, so you do it there. And you give me the answers. Now, why do we need the high purchase debtors? Because we need it for our what? Balance sheet. First scenario. But then, anytime you are doing high purchase, there is something you have to do. It's called provision for unrealized profits. Why? Because when you are preparing the income statement, okay, when you are preparing the income statement, you've sold the goods, but you've not received what? The money yet. So you have to make provision for what? Unrealized profit. So with that one, what we say is that the provision for unrealized profit is going to be the high purchase debtors divided by the high purchase sales times 100%. So you sold the goods, but that profit has not actually been realized. Now, why is that important? Because this is high purchase. So we've not actually realized the profit on the goods yet. That's why we need to do that. And so what do we have? 6154. What's the high purchase sales mean? 22822. So what do we have? Did I say times 100? Sorry. Times the gross profit. Sorry. Times gross profit. Now we don't have the gross profit yet, isn't it? So we will come back to this workings. Let's prepare our income statement. So income statement. Let's go. High purchase sales. So sales revenue is going to be the high purchase sales, which you said you got 22822. Then cost of sales will be the cost price, which you said is what? 16960. We less it. That gives us the gross profit. What do we have? 5,862. So this gross profit has not actually been earned. Why? Because the high purchase goods we've sold, someone can default. So we've not earned that profit. And nothing now, I calculated the provision for unrealized profit. You know? So now times 5862. What do I have?
15.
So we less provision for unrealized profit. 1581. So we bring it 1581. We less it. What do we have? What do we have? That will give us the actual profit realized. 4281. But the repossessed goods, when we sold it, what happens to it? We made a loss. So we less loss on repossession or repossessed goods. How much?
1767.
So what? Right. So that becomes our net profit. So that's how we prepare the income statement and the high purchase. I hope it's not difficult. Simple, sweet, straight to the point. Now you're off. I'll wait to me a day to be ready. In the balance sheet, the only thing that will come there is what? The high purchase. Okay? That's the only thing that will come there under this circumstance. The high purchase debtors, that's what comes there. Now, you saw that we calculated the sales figures, we calculated the cost of sales. But you remember we were told in the question that during the year, some goods were what? Or a good was repossessed. Now that goods that was repossessed, you realize that we did a workings for it separately somewhere. Are you getting it? Meaning that this sales figure actually is not supposed to include what? That goods that was repossessed. Meaning this cost of sales figure is not supposed to also include what? That goods that was repossessed. So we have to do an adjustment of that. We have to do an adjustment for that. So, like you did the workings here, just build it up from there. Deduct the July from the cost of sales. Deduct the high purchase also from the high purchase. And then let's get those absolute figures. So meaning there's a problem with our workings. That escaped me. So, what would you get? 12,000 for the sales. 12,960. And then the actuals, the high purchase sales. 822. So for those of you who write as I do, when do you? So let's get a new gross profit. $3,862. So you have to calculate the provision for unrealized profit again using this gross profit. Did you say 3,162?
862.
Okay. So give me the provision for unrealized profit again. Thousand. Divided.
14.
We go. And then okay. So that becomes our net profit. That becomes our net profit. So we have to take into consideration. So once the goods has been repossessed, meaning that its cost has to be subtracted from our cost, and its selling price has to be subtracted from what? Our selling price. So that's why we are doing that. Because you realize that we brought that as a debit to the repossessed goods account. So we need to take that into consideration. So that's it. So B, an important requirement of International Accounting Standard Board conceptual framework for financial reporting is that an entity's financial statement should represent faithfully the transaction and events that is undertaken, that it has undertaken. Required. Explain what is meant by faithful representation according to International Accounting Standard Board's conceptual framework for financial reporting. So what is faithful representation? People were talking about neutrality, prudence, completeness, error. Who was saying that? What is faithful representation? Should be free and fair. Free from error. What error?
Shouldn't be biased.
So we should mark this thing for you. You are actually defining reliability. You know, when it comes to the concept of features of financial statements, for a financial statement we have qualitative features and then quantitative features. Now the qualitative features, what are we supposed to have? This is, let me go there. Based on presentation, we are supposed to have understandability and what? Comparability. Then the content, it is supposed to be what? Relevance and what? Reliability. Right. So under relevance is where we talk about the nature and then the materiality. Then under reliability is where an information is said to be reliable, or the financial statement is reliable when it is free from what? Errors and bias. Then under reliability, and non four things. That is faithful representation, completeness, neutrality, and prudence. Inti emu baako, faithful representation na examiner say kan one say. Inti faithful representation does not necessarily have fraud and no, it goes beyond something. What is that? We say that an information is faithfully represented when the economic substance of the transaction is recorded and not what? When the economic substance of the transaction is recorded and not merely its legal form. So it's like substance over form. Okay? So the financial statement has to be faithfully represented, meaning that transactions should be recorded according to their what? Economic substance. Okay? And not merely their what? Legal forms. If you lease an asset, is it for you? Is it for you? No. So legally the asset is not for you. If it's not for you, then you're not supposed to bring it on the face of your financial statement. But if it's a finance lease, then you are now recording what? The economic transaction over what? The legal form. So if we go to law, that asset is not yours. But economically, you now control the asset. You now do everything on the asset. So economically, you record it on it. That is what we mean by what? Faithful representation. Okay? So transactions being recorded in accordance with their economic substance and not merely their what? Legal form. And not merely their legal form. So those of you who were talking about completeness, and some of you, the online students, you did that. Those of you that were talking about completeness, neutrality, prudence, yeah, all of those factors could fit in the way, but really, faithful representation is like that because you are talking about reliability when you bring all of those beasts in that kingdom. I should tell them. Yeah, I've told them. They have read. Then the next thing is International Accounting Standard Board framework for conceptual framework of conceptual framework for financial reporting requires financial statement to be prepared on the basis that they comply with certain accounting concepts, underlying assumption, and qualitative characteristics. 5 of these are margin and accrual, faithful representation, prudence, comparability, and what? Materiality. But you know these things already, so I'm not going to go through that. Margin and accrual concept, revenue earned should be what? Match against cost incurred. And then revenue is earned not when what? Cash is received, but when the transaction takes place. And expenses is incurred not when cash is paid, but when the transaction what? Take place. That's the matching and accrual concept. Make sense?
I was thinking.
There's Mama na ebebro agimu.
First, recording of transactions. Relating to the year
Yeah, that's part of it. That is matching your revenue against the income for the accounting period under consideration. That is the matching.
Okay, that is it.
That's the matching. Then the accrual aspect is when recognition comes in. So you recognize revenue not when the money is received, but when what? The transaction takes place. And then you recognize an expenditure not when the money is paid, but when the transaction will take place. That is why there is accrual. So it is matching and accrual. The matching is when you record transactions that belong to one accounting year or the same period. So revenue earned must be matched against what? Cost. That is the matching. But then at the end of the day, it leads us to the accrual, which means there are some revenue that you have not received, but you have what? The transaction has what? Taking place. Now, this kind of accounting concept is being solidified with the IFRS 15. You know, with IFRS 15 now, we recognize revenue not when the transaction takes place, but when the performance obligation is what? Satisfied. So this standard is really taking this margin accrual concept to another level. And so you need a deeper understanding of that. The faithful representation, we just talked about it. Prudence concept. What does prudence concept state? Meaning what? Provision for a liability. But prudence concept, we can say that it's why we say the accountant should exercise what? Judgment. Should exercise caution in making of what? Estimate. However, he is allowed to make provision for what? Future losses, but prohibited from making provision for what? Future profit. So in the making of the provision for the future losses, he must exercise what? Caution. So the fact that you can make provision for future losses, like provision for bad debt, provision for discount allowed, provision for depreciation, does not mean in order for you to reduce your tax into your provision anyhow you like. You must exercise what? Caution. How we are getting the idea? Comparability. What is that? Financial statements should be prepared in such a way that they can be one financial statement or one period financial statement can be compared with what? Another year financial statement. This is based on the fact that the company has to what? Use the same what? Accounting standard. So comparability fits into what we refer to as what? Consistency. Because if this year we use different accounting standard, then we can't compare it to what? Last year. This is why IAS 8 comes in. Accounting concepts, change in accounting estimates and errors. Now, when there is accounting concept and change in accounting errors, I think I discussed this when we were solving a question. And then there are two things: retrospective application and then what? prospective application. Monteda. Retrospective means we go back. We apply it to this year and then what? The forward year. So that's comparability. Financial statement should be prepared in such a way that one period financial statement will be what? Comparable to another year financial statement. And I said this is achieved through what? Consistency, application of what? Or treatment of transactions. Then the last one is materiality. When we say an information is material, what do we mean?
Information or understanding can affect economic decision.
Can affect what? The economic decision.
Based on the financial statement.
Okay, yes. So we can take that into consideration. So anything that will impact or affect the decision making of the users of the financial statement has to be materially reported well. Right. So in conclusion, basically, you see that we've solved the question on consolidation. Definitely we are going to see a question on consolidation. Remember to learn the principles. How goodwill is calculated, how net assets is done, how post-acquisition profit is done, how we deal with group retained earnings. But remember that when you are doing consolidated profit or loss, it is going to be a bit different from doing consolidated balance sheet. When you are doing consolidated profit or loss, you have to add what? Their revenue and subtract any intragroup what? Trading. Cost of sales, add their cost of sales, subtract any intragroup trading, the same figure. But if there is provision for unrealized profit, what do? We need to add it back to what? Cost of sales. Fair value adjustment, it is going to be there certainly. Make sure you understand how it is treated. Now, provision for unrealized profit, double entry is that we what? We will debit the inventory account and credit what? The cost of sales. This concept. So go back and watch the video on the concepts I made on consolidation in total, so that you get an idea there. Then when there is fair value adjustment in the question, and you are doing provision for, you are doing profit or loss, know how to treat it. If it is above, know how to treat it. If it is below, know how to treat it. Very important. Then you come to income statement or cash flow statement. Per what the examiner has done, we are expecting to set question on what? Cash flow. Is it cash flow? What did I bring in my mouth? Yeah, based on the examiner's behavior, we expect him to set question on the income statement. So make sure you deal with your footnotes. Nonetheless, don't leave any stone unturned. Standards, look at the various standards I mentioned. The core standards, 16, 38, 36, 37, 40, and then maybe IFRS what? 9, financial instrument. These are core, non-negotiable. Monday, before you get there, these standards, you can know them off head. Yes, regular customer. I nearly forgot that. So these are constant accounting standards. Then in addition to that, we said IAS 33. And then, so you make sure you get the standards very well. Because remember, 20-mark question plus the footnote to the single entity is going to be what? Based on standard. So make sure you focus on that. Ratios. Aside the calculation, make sure you can interpret. Remember the connection with it. How profitability, ROSI, asset turnover, net profit margin, they are connected. Liquidity, asset test, trade receivable, trade payable, they are connected. So make sure you're able to do those interpretations very well. Then, the no-man's land theory questions that the examiner is going to set. There will be question on conceptual framework and regulatory framework. Where they are questionnaire train or. So make sure you read through it and understand some of these things. Either accounting concept or faithful representation or whatever it is. The examiner can ask you a question on it. Then, the question 5A is where we said we are expecting the examiner to set the question on what? High purchase accounting. But remember, I did high purchase and partnership with you. I don't expect the examiner to set a question on branch accounting. However, if it strikes you that you have to learn it, don't leave any stone unturned. go through everything and position yourself well for the examination. I believe that if you're able to do these things, and remember time management, very important. In the 15 minutes, what did I say? Take it and read through the questions properly.
All 5 questions.
No, I didn't say all. What did I say? Maybe the standards. Read through them quickly using 5 minutes to find out what standard is in place. Maybe 36. Okay, if 36, what am I supposed to do? Maybe IFRS 9, financial instrument. What am I supposed to do? Then the footnote to the consolidation or footnote to the income statement. You read the footnote and find out what workings you can do quickly. Then decide which question you should solve first. As I say, maybe ratios is simple, but maybe in the exam it will not be simple for you. You said you will go for ratios. Start. Okay, so whatever choice that you want to take, take it. But first impression counts. So don't start messing up at the beginning. Start messing up at the end. And nothing I say, read through all the questions and find out which one can I do best first. Say, be our standard na easy, and you can do the standard first, go for it. Before you come for the ratios. But don't touch consolidation first. Please, I beg you. My knees are literally on the floor, on the ground, whatever it is. Please. You can't see them. What is it? We